If you look back to December 2007, and that was the first month of the Great Recession, the recession that accompanied the fall of Lehman Brothers. The rate of growth of full-time jobs at the time was 0.7%, so a tenth higher than where we are today. A lot of people blame the weather. It really wasn't a weather thing. We went back and looked at the history to the 1970s, and there wasn't anything extraordinary about this last January, even though it was cold. We did see a collapse in the work week. That's never a good sign. If the decline in the number of hours worked was to be equated to the number of jobs lost simply because of the income that was foregone, because hours were cut to the extent that they were, we would have seen a print of negative 550,000. So again, the headlines right now are extraordinarily deceiving.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Danielle DiMartino Booth. Danielle is the CEO and Chief Strategist of QI Research. She's also the author of Fed Up and a global thought leader in monetary policy, economics, and finance with 9 years experience at the Dallas Fed. So Danielle, thanks so much for coming on the podcast today.
It's great to be here. How are you?
Very well, thanks. We're just talking about how Powell had a surprise interview last night, which is on Sunday, which is quite interesting. But yeah, I guess sort of my first question, if someone were to just look at the markets, they would think, wow, everything's amazing, all-time highs, the economy must be doing great. But obviously that isn't the case. So yeah, from your perspective, what are you seeing in the economy?
Well, I mean, the best word to describe what we're seeing is cross currents. We're seeing cross currents between what's originally reported, the revisions that come subsequent to that, what we're hearing from the private sector, what we're hearing from official government data, what one survey in government data says that completely contradicts what the other is saying. So it's a very difficult time right now to read the tea leaves. You don't know what you're reading today, if it's going to be revised away tomorrow. That's certainly been the case, whether you're talking about GDP revisions or retail sales or headline payrolls. And so you have to do better at following what's happening on the ground, which is exactly what I'm trying to do.
And why is there that disconnect? Is it just is this abnormal compared to the past, or have things changed?
It's normal to see a lot of noise at inflection points, and that typically is when you see revisions, when you see the birth death model that's inside of one of the Bureau of Labor Statistics surveys. It's not abnormal for what we're seeing, but that doesn't make it any easier for investors. If you look back at some of the recessions that the National Bureau of Economic Research has dated, they've actually gone back and time-stamped recessions when it looks like the unemployment rate is at a very low level. But all of the other in the aggregate data that they're seeing add up to something that just doesn't make sense. These are veteran economists who are the arbiters, the people who decide when recession has and has not started. They understand the revisionary nature of non-farm payrolls and that they're the most lagging of all data for that very reason. And so sometimes it wouldn't be surprising for me to see the NBER come in and say, given the depth of the revisions to prior months' data, it looks like recession started in October of 2023.
Okay, so in your opinion, we're already in a recession, and then things are sort of starting to get worse. Is that what you're thinking?
So, yes, I mean, so many of the things that they look at, whether you're talking about inflation-adjusted income after government transfers, that's already turned negative. That is typically one of your biggest signposts and one of the laggards, by the way. You could say the same about industrial production. So there are many metrics right now that suggest that even though Jay Powell, chair of the Fed, is going to follow what the headlines are saying, which is what really is rattling the bond market's cage right now. So he's going to continue, press on with high for long. Even though that's the case, other indicators suggest that he is tightening or staying tight or staying too high into the teeth of recession.
And do you think he is going to, because as you said, there's a bit of a divide between what the markets think are going to happen, and I guess what the Fed and Powell think he's going to do. So do you think, I guess, where do you think it's going to go?
So I think that since the day of December the 14th, the actual day of the pivot, when the markets went, woohoo, we're going to 7 rate cuts. It's going to be great. Every single one in 2024. I think they have since dialed back their expectations. Now we're closer to 4, if not the 3 that he communicated again on 60 Minutes, saying it's just going to be 3 in 2024. Maybe we see the first rate hike in May. It might be as late as June. There might not be a rate cut on September the 18th. That's a toss-up. That's the FOMC right before U.S. elections. And history dictates that sometimes there are moves at that meeting, sometimes there are not. So we'll just have to wait and see how the headline data. It doesn't matter that we haven't had a single full-time job created since last February, a year ago. But we're going to have to wait and see how the headline data are reported to try and track Powell's next move.
Okay, that makes sense. And do you think that is that a mistake on his part? Because it sounds like the economy is going to decline and it's going to be a risk of things getting worse.
Well, yes and no. And I'm not trying to make excuses for Powell, except to say that he really is determined to put a dagger through the heart of the Fed put. He can't do that unless he holds on for longer than anybody expects. He can't do that if he starts to pull back from shrinking the balance sheet. He really does have to press on in order to buy himself time to move forward with some more strenuous regulations being imposed on the conventional banking system that then bleed into stronger regulations for the non-banking sector.
Okay, that makes sense. And I guess if I compare it to the other great power at the moment, China, they have tried to regulate some of their banking and other factors, and it's been disaster for them from a financial perspective as well as an assets perspective. So obviously the US is quite a different economy, but do you think there's a risk that maybe they're concerned that if they were to go too far in regulations, maybe tighten too much, something similar could happen in the US?
Well, the actual implementation of Basel III Endgame would not really come until 2026 or beyond. So when I say that Powell's trying to buy time, he's trying to buy time for the Chinese. When the Chinese want to impose new regulations, they just wake up one day and do it. In the United States, it's a little bit more of a collaborative process. You have at least a 1-year comment period from the banking community and other regulators. These things take time. We must agree and be diplomatic and what have you. So Powell knows that he's talking about the summer of 2026 for true implementation. So, as far as he's concerned, he's buying 1 month at a time.
Okay. Yeah, that makes sense. As you said, I think China just came out and made those changes rather than this slow process of making sure the forward guidance and the market is ready for that to occur. Yeah.
But again, I mean, whatever China is doing, it does appear to be very reactionary in nature and working the other way.
Yeah, I guess it's proven to Powell's point to be even more patient with everything he's doing and sort of slowly try and communicate what's going to happen. So from your perspective, it sounds like you were mentioning there that a job hasn't been created since February last year, a full-time job in the US. Can you maybe go into that further? And I guess what do you expect then in the coming months do you think further job losses?
Well, so we were in April of 2021, I guess, we were already having this. We were, I think, at 10+ % year-over-year growth in full-time jobs, and we've now slowed to 0.6% rate year-over-year as of the January data release. If you look back to December 2007. And that was the first month of the Great Recession, the recession that accompanied the fall of Lehman Brothers. The rate of growth of full-time jobs at the time was 0.7%. So a tenth higher than where we are today. A lot of people blame the weather. it really wasn't a weather thing. We went back and looked at the history to the 1970s, and there wasn't anything extraordinary about this last January, even though it was cold. We did see a collapse in the work week. That's never a good sign. If the decline in the number of hours worked was to be equated to the number of jobs lost simply because of the income that was foregone, because hours were cut to the extent that they were, we would have seen a print of negative 550,000. So again, the headlines right now are extraordinarily deceiving, and other indicators such as the ADP, which we know does not necessarily predict non-farm payrolls, but we know that 107,000 jobs created in the month of January was a pretty low number. And that by the same token, there were more than 103,000 jobs that were job cut announcements in the month of January that went to go offset that. So again, a lot of cross currents. Continuing claims just surpassed the level where they were in 2019 prior to the onset of recession. They're just about at 2 million, and they refuse to come down. They're very stubbornly high. So too many signposts for us to count. There was a very big services report that came out with ISM services for the month of January. Again, peel back one layer of the onion, and you see that in November, there were 10 industries that were growing employment. In December, that had gone down to 7 of the 18 industries tracked by the ISM that were growing employment. And that has now hit 3 of the 18 industries in the month of January that are still creating jobs, meaning 15 of the 18 are not. So we're seeing some very rapidly changing dynamics. But again, everybody got excited because there was a pop in new orders. Exports within services went up. What does that mean exactly? That means that a lot of foreigners came to school in the United States, and a lot of foreign tourists came to our shores in the month of January. So a lot of moving pieces, but the underlying dynamic of 10 to 7 to 3 industries growing their headcount is not a good sign.
Yeah, so as you're saying, it seems like the tightening's finally coming into play 18 months later, as a lot of people mentioned it would, how long it takes to permeate throughout the economy. So then so you don't think that Powell, even because he's set it forward that there's only going to be 3 rate cuts, if the data continues to get worse, if inflation continues to go lower, do you think he could make bigger cuts, or do you think, no, it's just going to keep the path?
If he's going to tighten his way into a credit event, then we will definitely see a much looser policy coming from the Eccles building, coming from the Federal Reserve. We could see unusually large rate cuts the same exact way that we saw unusually large rate hikes if the data continue to slow as quickly as they are. We at QI Research follow a proxy for headline CPI. In very short order in the last month, it's come down underneath the Fed's 2% target. It ticked down to about 1.8 a few weeks ago. And last week, it's ticked down to 1.4 where it's held. So it looks like the disinflationary powers in the economy are gaining momentum. Your downward price pressures are gaining momentum. If that trend was to continue, you could definitely see Powell being shaken off of his stance of wanting to be careful and measured with 1/4 point rate cuts, only 3 of them in 2024. If inflation starts to look like it's going to become deflation, then it's all bets are off.
Yeah, and if we look at it, he's already made the mistake with transitory, so I don't think he'll want to make the mistake for higher for longer inflation as well. That would be a disaster from his reputation standpoint, I think.
Yes. Actually, he said on 60 Minutes that the last thing he wants to see is deflation, but that he didn't anticipate it. So that means that if he does, then there's a surprise factor and he moves quicker.
Yeah. Do they look at this sort of forward looking indicators as well, or are they mainly looking at lagging indicators, the Fed?
They officially only look at lagging indicators, but he's much more of a pragmatist, I think, than people give him credit for. And we've also seen surprise moves to the downside in the core PCE, which is the official metric that Powell follows the most closely. So if that continues to come down at the pace that it's recently seen, that is the Fed's official go-to metric, as lagged as it is, and you could see a shift in policy.
Okay, that makes sense. Is there anything that that you're watching, I guess, in the data that is quite interesting to you or sort of unique in this situation that we're seeing?
Well, I'm trying to follow as closely as I can both the layoff cycle, the bankruptcy cycle, and what's going on in commercial real estate. And those are three areas of the economy right now that are hard to keep up with. And that certainly wasn't the case in 2022 or 2023 when they were much slower moving train wrecks, if you will. But we're just in the space of a morning, you see two companies that have north of 100 million in liabilities file for Chapter 11. You see a company like Estee Lauder come out and announce that they're going to be pushing through with layoffs of 3,000 of their staff. So these announcements are no longer small and inconsequential, and again, they're fastly moving.
Yeah, so it's keeping it on track with that. And yeah, commercial real estate has been another, I guess, big trend that people have watched in the past few years. It probably hasn't been as, even though we've seen these big announcements, it hasn't been, I guess, the movement that maybe as quickly as people were thinking. But we did see recently, I think it was last week, there have been some banks that have starting to write down some of those loans. So do you think that could be sort of a catalyst for another credit event, or I guess at least another wave of the Fed having to come in and sort of save some of these banks? Or what are you currently seeing there?
Well, it certainly does give you pause. It's not so much one bank in New York, New York Community Bank Corp, and that's a small bank. And you say, well, there's nothing systemic about that, and that's not problematic. And then you wake up the next morning and learn that there's a big bank in Japan that has got some serious losses in American buildings, in American commercial real estate. That's a different dynamic. When it's a parallel to German Landesbanks. We found out in 2008 having concentrated holdings of U.S. subprime mortgages. It said, I didn't see that coming. You didn't see that coming, and I didn't know that this big Japanese bank was going to come out last week and say, yeah, it's our problem too, halfway around the world.
So I think what you're saying there is still sort of a bit of an unknown about who's holding the bag, I guess, and then when are they going to have to write it down?
Yep, that's exactly right. And we've seen, by the way. It's one thing to talk about commercial real estate holdings that are United States on a Japanese bank balance sheet, but it's another to see, commercial real estate in local markets, whether you're talking about Melbourne or Singapore or Hong Kong. So it's definitely a global phenomenon that merits monitoring very closely, because it's not just U.S. commercial real estate that appears to be deeply impaired. We know that there was speculation and paying too much, paying too high of prices all over the world. Cheap money was a global phenomenon.
Yeah, it's a good point. And I think, I'm sort of living in London at the moment, one of the frothiest markets. And those are really the places where a lot of people paid, maybe not for the best things, but for the sort of second and third tier properties. That's where they've paid over, and they're going to really struggle to make their returns back, and going to have to take losses, I think.
Yeah, and that's really where the zero bound would come in handy right now. But we're nowhere near the zero bound. We haven't even seen the first rate cut. But when it comes to a lot of these people that are in financial distress, whether it's commercial real estate or the need to refinance bonds, the zero rate sure would be a big help right now.
Yeah, and it doesn't seem like we'll get there soon. So if I were to put you in Chair Powell's shoes as the chairperson of the Fed, what actions would you take? Would you sort of continue down the line, or do you think that he has to take action sooner? What are your perspectives on that?
Well, I certainly would try and continue to shrink the balance sheet as aggressively as he can without breaking something. So I would think that you could at least take another $1 trillion off the Fed's balance sheet and try and continue down the path of normalizing the size of the Federal Reserve's footprint in the U.S. Treasury market, which had become problematic. They'd become too big of a player, too big of a presence. So I would try and maintain that particular leg of tightening, even if the economy dictated that it was time to start cutting back the actual level of interest rates. And I think that we are seeing evidence thereof. But again, if he's looking for high for longer, and if regulations and regulating the non-banking system is paramount to actually have something to show for a Fed cycle, as opposed to coming out at the other end and slamming rates right back to the zero bound and resuming quantitative easing. And then you wake up and then the non-banking market is just that much bigger, and you've accomplished approximately nothing. Then, I would do the same thing that Powell's doing and try and press forward and actually have consequences for speculation that has been taken, as opposed to just rewarding behavior that ends up costing the broader economy in the end, but yet enriching the biggest players in the private capital sector.
Yep. So I guess renewing price discovery of many of those assets, which will hopefully benefit over the longer term.
Yeah, that's an interesting concept, price discovery. But yes, that's the goal.
Haven't seen that for a while. It's just up and up, I think, recently. So is it possible that they could cut interest rates while continuing with QT?
Well, they've certainly alluded to as much. They've certainly said that they could continue to shrink the balance sheet, maybe at a tempered pace compared to where they are now. And certainly if they're lowering interest rates, and that was to show up in people paying their residential mortgages off at a faster pace, then the Fed could allow the mortgage-backed securities to come off of the Fed's balance sheet while they pull back on quantitative tightening on the Treasury side, and just say, hey, we're going to play catch up. We wanted to. We had the goal of rolling $25 billion of mortgages off per month. We were not able to do that beginning of June of 2022 because mortgages were being prepaid so slowly. So we're going to catch up on that side while easing off of the Treasury side. There are a lot of different ways that the Fed can approach shrinking its balance sheet. If it did so, as with as much imagination as it went into full-blown crazy levels of quantitative easing, then we might accomplish something here.
Yeah, I think that's what we've realized recently is that, a lot of people thought it was just interest rates that they had control of, but no, they have all these tools and tools that we don't even know of yet that they're going to bring out when they need to, and to do what they can to save the economy, reduce the balance sheet, all these different things.
Yep. Anything's possible.
Yeah, definitely when you have can do what you want. So if we look at, I guess, assets for 2024, it seems like it's going to be quite a difficult period. What assets are you thinking will potentially perform during this period?
Well, when you hear and see what happens when any given company cuts their dividend, get out of the way. So I tell people that, if it's important that they be or have exposure to the stock market, then they need to be choosier than just being a passive investor. They need to make sure that there's not even sufficient earnings, but sufficient cash flow to maintain a dividend. Make sure that you're collecting income from that equity, if that's indeed what you have to have, a level of yield. And if Chair Powell is going to take rates down as slowly as he says, then that portion of your portfolio that's allocated to cash is going to continue to be rewarded handsomely. There's of course something to be said for maintaining your gold holdings, which do well in times of financial distress, and then very high quality, probably short in terms of maturity, but investment grade corporate bonds. And I mean the best of the best. Okay,
that makes sense. And I guess, if you look at the high beta assets have performed recently, but that's because of that expectation of interest rates cuts. And if they don't come, then there could be a panic and sort of a rush for the door, I guess, in the short term at least.
And there is, and we're also seeing critical mass in terms of the number of people who've been laid off in the white collar sector, the ones who have really propelled this passive investing shift away from active investing. But between the baby boomers taking distributions and just the sheer number of Americans who've lost their job and used to be very, very recently were aggressively pushing inflows into 401ks, if the combination of white collar layoffs and baby boomer distributions is such that 401k inflows reverse, well, then, there might be a little bit less magnificence in the magnificent seven, so to speak, that most benefit from passive investing.
Yeah, it's a great point. And I guess we've seen lots of people retiring recently as well, probably because the stock markets are high, their assets are high. So maybe if they were to, if that were to reverse, they might have to come back into the workforce, and that could put further
Well,
pressure
we're
on
certainly seeing a
unemployment.
pop in the labor force participation rate for those who are 55 and older, certainly.
Yeah, very interesting. So Danielle, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
So don't take the headlines at face value. Yeah, do the work yourself. Peel the onion back, and don't forget that when it comes to exogenous shocks, and just Google it. It means something coming from the outside that you're not expecting. Don't forget that we're in an election year, and that can be its own game-changing element.
Yeah, it definitely seems like a period of time where there's all these exogenous shocks, and that are very hard to predict. So hopefully we get through, but we'll see. So yep, Danielle, thanks so much for your time. Appreciate it. If anyone wanted to find out more about your work, would QI Research be the best place for that?
QA research, especially if you're an institutional investor, or come to dmartinobooth.substack.com. And of course, follow me on Twitter at dmartinobooth.
Perfect. I'll pull that in the description below. But yeah, thanks again for your time.
Thank you. Take care.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.